All right, so now we're going to move into the second threshold of the time for equity investments. And remember, now we're moving from that insignificant or no significant influence moment where we're just a day trader. We're looking at the gains and losses because, hey, we don't have a substantial enough ownership to really warrant anything but the idea that we're just in this for the return on share price appreciation, right? We're buying low, we're selling high, we're an insignificant person in our company's investment portfolio, in the investee, and so we adopt the fair value method. Now, the equity method steps up our influence a bit. It's between 20 and 50%. And we do have influence, but not yet control. We do take an ownership perspective where now we're valuing the investment through net income and dividends rather than how the share price is fluctuating over time. So that's the idea, right? Instead of being this sort of passive investor, now we're investing in the net assets of the investee. So our focus is moving from stock price. So it moves from stock price movements or fluctuations to increases or decreases in the net assets of the company. And remember, the net assets of the company are essentially its equity, right? Net assets are assets minus liabilities. And we know that from the accounting identity, that assets minus liabilities is equal to equity, right? So that's our focus when we are in an equity method moment, right? Um, so when we shift that focus, we have different journal entries. We still record the investment at the money paid for our proportional ownership. So proportional ownership meaning we own 20 or 40%, right? And we credit cash or whatever the means of payment are. Sometimes we're acquiring this through stock, and that's, we can look at that later as well. But let's just assume cash for the moment. So we debit our investment in X, or sorry, investment in S, right? Our investment in S kind of going, but we'll be using S and P a lot, subsidiary parent. So we do have an investment at cost. And again, just assume cash for the moment, how much cash we spent. And again, this is just an asset for an asset. A distinction between equity method and the fair value method is this investment in S account is not trading security anymore because we don't have insignificant influence and we're not that day trader looking for just a stock price fluctuation to trade on, but rather this is a long-term investment, right? The logic behind it is that we didn't buy, say, a 40% interest in a company just to turn around and sell all those shares, right? We're in it for the long haul. We're more interested in how the net assets of our investment are moving, how the equity of our investment is progressing over time. And since we're taking that net asset approach. What we're really concerned with recording here, again, is not that price fluctuation, but how does the equity account of our investee change over time? And so we're going to look at that through the two things that primarily affect equity for our investee: income that the investee records and dividends paid by the investee. So if we have net income, if I'm sorry, if our investee, the stock we're invested in, has net income and reports net income for the period, Then we debit our investment account in that company, and then we record in some income from S as well. This is an increase to our investment asset account that is held as a long-term investment, and it increases my net income. This is non-operating or other income because it represents income that's arising from our investee. So not operating. Now, what we're going to record this at in terms of dollar value is the net income reported by S times our percent ownership. So if we have significant influence, but we're not exerting control, then it's somewhere between 20 and 50%. So we look at how much the equity of our investee changed from the influence of net income, and then reckoning with the fact that we own less than 100% in this case, somewhere between 20 and 50. And so we can only report and record on our income statement and balance sheet our proportional amount of that net income. Net income would increase the equity of our investment. And since we're tracking the net assets instead of the price movement, instead of the stock price movement, we're tracking the change in net assets. Since net income is increasing the net assets of my investee, it also shifts and increases my investment in S. We record that income from the subsidiary as well to show the income effect of that increase in our investment in S. If there's a net loss, then the same but the opposite happens. We have a debit to our income from S for the amount of the net loss times the percent ownership. And then we also credit the investment account because the loss in our investee would reduce the net assets that we're tracking, just as net income increased them by the proportional ownership that we have. And this would, of course, reduce net income. It would still be other income or non-operating income. And of course, it would reduce our asset as well because that loss has eroded some of the equity that we've invested in, some of those net assets that we've invested in. And this is still a long-term investment that's recorded on the investor's balance sheet. Dividends. What's the effect of dividends on equity? So if we declare dividends, right, that's a hit to retained earnings, and therefore it reduces equity. So when our investee is paying dividends, they're reducing their overall net assets. I, as the investor, would, I'm just trying to emphasize the or versus the E. Our view as the investor is that we receive cash, but even while we're receiving cash from the dividends paid, we also recognize that this is a reduction to the net assets of our investee, and so that needs to credit the investment account. Since remember, our investment account is being tracked as movements in equity or net assets. So this would be by the dividends paid times our proportional ownership. I should say total dividends paid multiplied by our proportional ownership. So that increases an asset because we do receive some cash. It reduces our investment account though. Okay. No net income effect when dividends come in through the equity method. And this is a big departure from the way that we record the dividend if we are not under the equity method, but we're doing the fair value method and tracking those price changes. Remember, of course, changes in market value are ignored because we are not looking to sell this investment. We're in it for the long haul. So the more relevant measure is tracking this investment in terms of our proportional change in its equity. Let's look at an example to try to concrete and lock this down. So on January 1st, Able acquired a 25% interest in the common stock of Kane at a cost of 2 million. The cost of Able's investment equals the fair value and book value of the net assets acquired. So the cost equals the fair value and book value of net assets acquired. This is an assumption that will relax in a bit because essentially what this assumption is making happen is that there is no positive or negative differential. We're not paying more than the book value or fair value. And so we don't have to have any special accounting to deal with a differential. Subsequently to the acquisition on January 1st, our investee reported net income of 4 million and distributed a cash dividend totaling 1 million. So, what is the total book value and fair value of the net assets if 2 million buys 25% interest? So this is just a little bit of a math problem to see to recognize what we're dealing with here. If we pay $2 million, basically what we're asking is $2 million is 25% of what dollar amount, right? Because if $2 million represents 25% of the ownership and the ownership fair value and book value are on point and we paid exactly that amount, we can set up the equation to solve this way. This is a handy trick I learned in middle school, and people mistake how to scale up from a lesser percent. And so the equal sign is placed wherever the is. 2 million is 25% of becomes a multiplication sign. What dollar amount? So really it just turns into a simple algebra equation where we're solving for x. And so we divide 2 million by 25% in order to gross that up to what the total price would be, which is 8 million. So this is the book value and fair value of net assets of Kane. What is the journal entry used by Able to record the acquisition of equity shares? All right. Well, again, this is just at cost. So we debit investment in Kane by 2 million. We credit cash by 2 million. Simple, at historical cost. No crazy accounting needed to record that. Record the income earned by Kane during the year. Well, if Kane earned $4 million of income, and I own 25%, right? Then it increased the net assets of Kane by 4 million. But since I only own 25% of those net assets, my investment in Kane goes up by 25% of 4 million, which is 1 million, of course. That increases my long-term investment. And I would record a credit to income from Kane. And then finally, to record the dividend, remember the dividends reduce equity of Kane. And so since I'm tracking my investment in Kane as an investment in the net assets of Kane, as that equity method tells me to do, then I'm going to take the amount of dividends, the total dividends, 1 million, to all shareholders. And since I represent 25% of those shareholders, I record $250,000 of dividends from this effect. I receive that as cash because I am a shareholder, so those dividends are paid to me in cash. But I do not record revenue because I'm tracking this investment from the net asset perspective. And since it reduced the net assets of Kane, it's going to reduce my investment in Kane. All right, so what are the income statement effects here? The income statement effect would be our income from Kane, income from Kane. It would be non-operating or other income on the income statement. It would affect net income, and it would be for the amount of 1 million. And what is the book value of our investment in Kane? Well, we can just make a Swift T account here. We started at 2 million. We debited that by 1 million when when Kane recorded net income and increased the overall equity through that income. And then we reduced our investment when our investee declared dividends and paid us cash. So it went up to 3 million, but came down by 250,000. So now it's at $2,750,000 at the end of the year after those adjustments have been made. So this would be my investment in Kane, long-term investment. Now, to note, if we had purchased the investment at a time other than January 1st, right? So if we had purchased this investment, say, um, at March 30th, okay, if 3 months of the year had passed, then we would have to adjust the income for the amount of income earned only since we had purchased it. So we would only want to take 25% of the net income that Kane has earned since March 30th, right? We would not be entitled to any of the income that they had earned prior to that because we had not yet put our investment in there, and therefore we weren't tracking the movements in equity or net assets for our investee. Now we're going to talk about oh, and one more little caveat. So let's say that we put we invest in a company, and so we have our investment in C, and now it's at 2.75 million. But let's say they had year after year of losses, such that instead of recording debits here, we would have losses. Those losses would reverse this entry. We would be debiting income from Kane to show as it is a loss, a debit. We would be crediting our investment in Kane to show that those losses are eroding our net assets in Kane, right? As Kane is recognizing those losses, their equity is dropping, and therefore our proportional ownership, our investment is getting credited as well. If this falls to zero, then we do not push it any further, okay? Unless there are certain contractual arrangements that I, as an investor, have to cover beyond my investment. Because remember, if there aren't these contractual investments, investors have limited liability. Their losses are limited to the amount of their investment. They don't have to cover more. So unless there's special contractual stipulations that say we're responsible for those, then we only allow this account to be zeroed, and then we stop recording any effects. We only resume recording effects after the company has earned back to the point that earned back all of those losses over time. So we do need to track it. We just don't make an accounting record for it. But let's say, for example, if the company experiences losses in total of 175, after it has already reached a zero balance, then we can only begin recording revenue as a debit to the investment account after it had earned back those losses that occurred after this account balance became zero to reflect that limited liability of owners in this corporation.